Mark's the CEO of Neu Capital in Africa. He's a specialisation in capital matching, I guess, of investors to very good, high-quality African deals in the $5 to $50 million range. Mark's worked with the Moore team quite a lot, and energy being one of the core sectors that they specialise in. And Mark will just cover off on macro trends in energy in particular. And then I'll talk a little bit about capital markets and things we can do to make life easier for our clients.
So I think the key thing that I wanted to just share with you today was what we're seeing as the macro energy themes in the world and how those are impacting capital raising. And I'm going to focus a little bit on capital raising as well. So if we can walk through it then, the first thing to do is just the macro energy themes in Europe, Middle East, and Africa, since those are the areas we're focusing on. Firstly, I thought, just what is at stake? I mean, this is always for me a useful map. It shows us the extent to which GDP will change by 2050 based on global warming. And I think it's a useful snapshot because it reminds us, for those of us who are in Africa, as I am, Middle East, India, and the rest of Asia below China, I mean, these are significant countries that are going to be affected. So these are important issues. The big themes that I wanted to identify really are that there's going to be a steady to growing demand for energy, certainly in the next 5 years. And if I move into the scenarios that have been developed by British Petroleum, in fact, these were released yesterday. And the three scenarios you have there are: the green is business as usual, assuming that we don't make any material changes, but we continue with existing policies and behavior. The green line indicates what happens from 2020 onwards. The orange line is the rapid, is more rapid transition, and certainly transition away from or decarbonization. And that indicates that we pursue the policies that governments are offering us. Or are proposing, and that they're implemented and they're followed. Of course, human beings don't behave like that entirely. They don't do what they're told. So the net zero, which is the blue line, indicates the level at which to get to net zero, it requires not only that government policy is pursued, but that as human beings, we make societal changes. So these are the three scenarios. None of them are predictions. As is the case in scenario planning, but it's very useful just to look at that and see the impact. And so when we look through some of these BP scenarios, and I pull them out because they're so current, they're more current than the IEA's latest set of figures that were issued in April. And if you look here, you'll see the changing structure of the global energy demand. Fossil fuels dropping. You can see that in every scenario they drop through to 2050. You can see renewables growing, and they're growing obviously more dramatically in a net zero environment, the blue line. And these give you an indication of the general direction of travel that we will see in renewables and fossil fuels. Perhaps more interesting and more stark are the global power generation numbers as they run out into the up to 2050. And again, if you look at the rapid, on the far left is the rapid scenario. So this is government policy. Net zero is assuming we also get societal buy-in. And the far right is the business as usual, things just continue. But it's clear what's happening. I think the next thing to perhaps pick up is on geopolitical uncertainty. And I thought it interesting just to grab a sample of events that have happened. Some of them have happened this year, but some of them, in fact, would happen today. So we know about the OPEC plus instability, the problems between Russia and Saudi Arabia, and the collapse in futures prices earlier this year during lockdown. Europe, we see things like the Navalny dispute, Nord Stream under threat. We've seen Elon Musk move his Tesla Gigafactory to Berlin in response to Brexit threats. Today it was announced by Australian Vanadium that they are entering into a Chinese JV to develop residential vanadium redox flow batteries, and we'll hear a bit more about that possibly as well today, but that's a really exciting development. We're seeing threats in Africa, northern Mozambique, attacks on the the LNG fields. We're seeing Exxon exiting from the South African oil and gas exploration activities, and yet there are opportunities. It looks like we're going to open our bid window number 5 in South Africa for renewables in December. Burkina Faso announced in the last few days that it was launching a tender for 9 megawatts of solar. Namibia and Botswana, these are interesting developments that are taking place across the world. And I think the point about the geopolitical events is that it's very, very difficult to know where the next shock will come from and what and how exactly these will play out. COVID-19, of course, has been on everyone's lips, and I'm not going to go through each of the numbers, but the COVID-19 oil shock has been significant, and the IEA numbers are there for you to see, and you can pick them up if you want to have a look at my slides after the event. I think they'll be. So this goes back to April 2020, and with the expected numbers that by which oil would drop and power usage would drop over the rest of the year. So I think the ramifications for capital markets become quite important. FT actually said, the FT, or Financial Times said that peak demand had been reached in April this year. It was their assessment. But either way, we're seeing sluggish oil prices, risk of further gluts as gas competes. If projects require a break-even of above $35 a barrel, they're going to be stranded in all probability. With weakened public finances, we're going to see trouble, more difficult to actually finance, for governments to finance utilities. Corporate off-takers are going to be less credit-worthy under I think the current pressure that has arisen out of COVID and out of the long-term decarbonisation of the energy mix. We're going to almost certainly see oil and gas E&P consolidation across exploration production companies. We see distributed renewables becoming more the order of the day, much more nimble than utilities, and they will continue probably to outflank the big utilities. We'll hear a bit more later, I think, about solar PV and how that continues to grow. We've mentioned battery power, and storage is the next big technology frontier, and that will enable the wheeling of power and the distribution of power significantly. I think David will speak about small modular reactors, and he'll be much cleverer about that stuff than me, so let me not mention it further, other than to say that it's, nuclear seems to be a very badly maligned energy generator, whereas I think that handled wisely, there's some real opportunities to make a difference. So just in conclusion on the broad themes, before I move to capital raising itself, we have to resolve these tensions between affordable energy, climate change, and security of supply. And there are a number of features that we will have to navigate, and flags we will have to watch to see just how fast we are going to change and which of those scenarios may play out more likely scenarios for the future as presented by BP. I think the final comment just before I move on is that energy is very capital intensive. So participants, we do need to ensure that we have considered matters carefully, and that we have strong advisory teams around us to ensure that any presentations made to investors are really carefully considered. Maybe moving on to capital raising lessons, if I may. So just jumping in. Firstly, I think best practice in the mid-market. We specialize as a capital matching, we're like a Tinder for African capital, and we support high-quality corporate advisors. We support the South African team, the guys in South Africa we've been working with across Africa. And we've identified some best practice in the mid-market, the $5 to $50 million market. And the first thing is that if a deal is not good and fairly valued, you've got a problem. The second is that you need a respected corporate finance advisor if you're raising capital. And too many clients try to do it themselves, and then they come back in tears later and try to get, persuade the advisor that now's a good time for them to jump in and half the work's been done. which always reminds me a little bit of, you know, if your wife goes and gets Botox and it's a mess and she goes back to the plastic surgeon later to ask the plastic surgeon if they can fix it up. You don't tell the plastic surgeon that you've done half the work and you have to do it could they do it at half the price. So I suspect that's a shared issue amongst us, all of us who are in the capital raising market, but you see this kind of stupidity from people seeking capital. Investor readiness can't be underestimated, and you know, again, strong, not just the corporate finance advisor, but tax, you know, corporate preparedness, right down to company secretarial. Everything needs to be well prepared before you reach out in this market. Quality IM always flows from a respected corporate finance advisor, and that cannot be underestimated. And also capturing the narrative. It's no good just ticking the boxes, you've got to capture the narrative. And when we reach out, we like to work very anonymously, very discreetly, and we always work with an anonymous teaser. Another thing on retainers, well, we all know that we must be asking for retainers, and this no pay, no play principle is really crucial. But if we don't get a retainer, we will not do business. For us, it's an absolute no-no. And I imagine that the same is shared by other corporate finance advisors on this, perhaps listening to this. But that's a crucial issue, and it demonstrates commitment. Finally, on the sort of negotiating side of dealing with your clients who are raising capital, we always insist on exclusivity, as I know the guys do in SA. But particularly, we don't like carve-outs. And the reason we don't like carve-outs is when people carve out investors, they tend to create a situation where the incentives are all wrong. So if someone comes to us and wants to carve out 3 investors they've approached, our difficulty with that is that it means that we're going to create competitive tension to help close those 3 investors. And no one really knows who's finally going to come to the party. So it's a bit like incentivizing your goalie to score goals on a football team. You know, it's going to be out of position all the time. So we don't like that at all as a thought. And we think it's crucial to understand the investors. We try to understand investors at a mandate level or in great detail what their portfolio is looking like. And we talk to over 300 investors at any given time. We're talking to over 300 investors who can write checks of $5 to $50 million in Africa, for example, and you really got to know what they're looking for, and it helps you to hit the high points with them. Finally, we don't like well-shopped deals. If someone brings us a deal that's really well-shopped, and I'm sure you feel the same way, it's also a bit of a recipe for disaster. And then finally, we're seeing that there's not a shortage of capital. The capital's not being unlocked at the moment easily in the market because of lockdown. We think that's going to, those purse strings are going to loosen. And if you're not in the queue early, your problem is not going to be accessing capital, it's going to be accessing human resources in the investor teams. So investors just will not have the human capacity to deploy their capital when things get going. So just worth noting. I wanted to pick up on some some energy issues specifically. The first is just the difference between companies and projects. Investors prefer projects. They can cherry pick, they can pick their risks, their off-takers, they can check that the CPs have been met, they can make sure the team is properly selected, there's no head office drag, they prefer projects. So going out to try and raise capital for companies with a head office drag is not that easy. And unless you have a tremendous track record, projects are always going to win out. We also think that with the commoditization of solar and wind, your key drivers, your key economic drivers are the cost of the EPC, the cost of engineering, and the cost of capital. And beyond that, it's very hard to find other value to add to these deals. So you've got to be realistic about your value add. As I said, you need an enormous track record to attract capital to Topco. So we would recommend anyone who is getting into this market to really start at project level to prove their worth. And in fact, they may always be confined or consigned to having to work in the project space. The other advantage of projects is actually that you don't really always need a strong balance sheet. Whereas if you're raising money at a company level, that's one of the first things that gets looked at. The next point just to raise is oil and gas. I mean, oil and gas is in a world of pain. It's brutal. We think that with the private investors are now very wary of investing in oil and gas. The losses in US shale, for example, have been devastating. So we see that the E&P market is going to consolidate. There will be players there in the M&A space for those of you who do that kind of work. And if you're raising capital, which is what we do, we think that private equity and financial investors, financial equity investors are inappropriate. You need long-term strategic investors. And those are going to be DFIs, they're going to be governments, it's going to be the big players that are going to be investing in that. The next thing perhaps just to mention is on your business model. You know, the business model's got to, you really need to be able to offer something that's differentiable. And so we think playing downstream is really important, where the profit is more likely to be controllable. The upstream projects, as we've said, are commoditized, but you know, investors we see at the moment are looking for value much closer to the customer, you know, metering space, retail space, offerings that you can brand. But this is where the higher margins are going to lie, where you can control your own destiny and not be at the mercy of the vagaries of geopolitical issues. Finally, just on our final comment on this space is just on the renewables, is that you know, we see it as a bit of a race to the bottom. The paradox is that to achieve grid parity, prices have to drop. But if they drop too much, it's hard to find returns. So there is a paradox about that. We see renewables continuing to attract institutional capital. We think returns are getting compressed. It's going to get much, much tougher. We think that the mid-market is especially going to be tough. Scale as a strategy, you know, you're going to be competing with the big utilities. So those are some perspectives perhaps on renewables. And just in conclusion, you know, you need a great deal and a great management team. So you need a great advisory team. So it's great to be talking to Moore. You need a great plan and you need a great deal distributor. So please speak to us. Thank you very much.